Howdy, Jacob here. Today we're looking at Telefonica, ticker symbol TEF. It's in the diversified telecommunications service industry with $23.4 billion market cap, $13.3 billion enterprise value. Interesting. Looks like there's net positive cash compared to debt. Looks like they provide telecommunication services in Europe and Latin America. They revenue side, very large decreases actually, 69.2 billion in revenue in 2013 down to 42.3 billion in 2022. Return on invested capital outside of really 2021 is low to mid single digits, but they do have a 7.9% dividend yield. So huge yield there. Let's see if they can afford that. Their aggregate payout of $1.9 billion and 5-year average of probably 6 billion, 7, maybe $7 billion. They can afford that dividend right there. And then outside of that, the last 5 years, just humongously paying down debt. That's great to see. They still have 34.5 billion in long-term debt, 3.9 billion short-term debt, and then cash and equivalents with short-term debt is about $9 billion. So they are net debt, so that enterprise value here doesn't appear, um, quite correct. But um, the debt situation of 35 billion, 5-year average was about 7 billion. So roughly 5 times their 5-year average free cash flow on their long-term debt. You really want it to be, I feel like, a well leveraged company. It obviously depends, but on a safe side, probably like 2 to 3 times 5-year average. Anything less, and maybe they're giving up growth, but it's a fair business, pretty conservative. And then on the upper end, you're just kind of levered for the most part. And so, is this dangerously levered? I don't necessarily think so. I think they have been focusing a lot on paying down that debt, which is great for them. It's likely a great use of their free cash flow. But it does look like they've been increasing that dividend, I guess, just in the last 3 years or so, because their roughly $2 billion payout on 7 billion 5-year average is pretty low, about 29%, under 30% payout ratio. Pretty conservative there. I think I'm ready to make some assumptions here. I think as for the growth of the business, we're really not looking at much growth here. I mean, it might even be negative over the next 7 years. So I'll say -1 on the revenue side, and then say that, yeah, they still have stuff ahead of them, but I think that although they'll be able to, increase revenue on inflation side, I think just the demand is going to be a bit greater than that. And then after 7 years, they're so big that it'll probably be a similar story to where this PE and price to free cash flow, I think, is still safe. 15% return. As for margins, 7%, 12%, maybe 6 and 11, or 6 and 10. Share change, let's go 0, although they bought back stuff here, increased it a little bit there. And then, I mean, on the dividend side, I could see them, they can't afford to bump it up. It looks like they're not making acquisitions. They're divesting more than they're investing. And so they're also getting cash from that. And so I think just when the shares get really friggin' cheap, you want them to be buying back as many shares as possible to give the back the greater ownership to the shareholders. But I mean, it's not a bad idea to pay a dividend when they don't have great investments and or great return on invested capital, and maybe the stock's not there yet to where it gives you a massive return, and then paying down that debt to where they're as less levered as possible, I think, is a great idea. But I mean, their payout is so low, I could see them increase it maybe 3% a year for the next 7 years, and then maybe it gets to well, I guess we have declining revenue. So let's say 2%. They're able to get to maybe a 50% payout, and by then their debt is so low that it's almost 50% between share buybacks and dividends, just depending on how cheap the stock is. I think that'd be a great capital allocation plan. And that gets us to a price that needs to fall roughly 25% before you get a 15% return, given these assumptions. Again, I've said this in a previous video, I'm sure, but a declining business is still worth something. And so, even though I'm saying it has -1 revenue growth change each year over the next 7 years, you can still get value due to them producing very positive free cash flow. And so, keep that in mind when reviewing businesses. I think this is a fine business. I mean, yeah, it's declining, so it's not necessarily the longest term dividend play. But I think over a 5 to 10 year period, if the stock gets cheap enough and their business quality stays the same, and they're producing very positive free cash flow, their payout's not super extensive, I think this could be a great stock to add to a dividend portfolio. So I hope everyone learned something, enjoyed the video, and has a great rest of their day. Thank you.